We get hundreds of questions every week into our office, and today I'm going to jump into 12 key questions that we got recently on our social media platform. So today we're doing 12 and 12, 12 questions in 12 minutes. Everything around tax, retirement, and estate planning. So let's dig into it. Question number one, I wonder if you could talk about a dynamic withdrawal or guardrails approach to drawdown in retirement. It seems that with a flexible approach, a retiree could spend more throughout their lifetime as long as they are willing to cut a portion of their discretionary spending when markets are down. Conversely, when markets are up and the portfolio is doing well, they expect they can take a raise. Now, this is a big no-no, and this is the whole idea of actually building out that cash wedge. We don't want your retirement to be a roller coaster. You may only have 5 or 10 years of go-go years. Well, what happens if the market's down for 2 or 3 of them, which it probably will be? You're losing 20 to 30% of your good retirement years because you didn't plan accordingly. So instead of kind of pulling more out in good years and not spending as much in down years, build that cash wedge to make sure that you can have a proper income source right through retirement, whether the markets are good or bad. You're drawing on that money and you're not selling anything in the down market. So again, the cash wedge would fill this, but make sure your income in retirement isn't a roller coaster. It should be well thought out and well planned for to avoid this. Question number 2, is it true that once someone reaches 65 and this person is still working full time, you can go ahead and set up a RRIF? So convert your RRSP to a RRIF and pull out $2,000, which would qualify for the pension income tax credit. So yes, this is correct. You can convert your RRSP to a RRIF and draw out $2,000 every year. So you'd move $2,000 from your RRSP over to your RRIF, pull that out, and it would qualify for the pension income tax credit. But that tax credit is based on the lowest tax bracket. So if you're earning income, again, it's not going to offset all the taxes necessarily because you're adding that $2,000 at your marginal rate, a much higher tax rate than what your credit will be worth. So again, it's not free, but yes, there is a tax credit and probably not a bad idea for many to implement this strategy, which we've talked about many times on this channel. Question number 3 is, I've heard opinions that people making less than $50,000 are better off investing in non-registered than RSP. Is this true? Yeah, typically under $50,000 to $60,000 a year, you might want to consider looking at investing in a TFSA. Maybe not a non-registered, a TFSA versus your RSP. So if you have $5,000 to save that year and you're only making $50,000, so 10% of your income, yeah, you probably want to look at a TFSA versus an RSP. Again, make sure you're utilizing your TFSA, your tax-free savings account, over non-registered. Again, that money grows tax-free and you can pull it out tax-free. A non-registered account, you're going to be taxed on the gains on an annual basis and or when you pull it out. So again, make sure you understand that. But yeah, there's this tipping point where $50,000 to $60,000, that's when the next tax bracket usually jumps in most provinces and territories, is going to make the most sense to utilize a TFSA under that amount and look at an RSP over that amount. And again, a general rule there, but something you should look at. Question number 4, looking at OAS clawback, is it more feasible to sell a Canadian dividend stock and switch to a non-Canadian, non-dividend paying stock? My feedback on this is if you're getting this nitty gritty on avoiding OAS clawback, I don't know. I think you want to buy the best investment that you think will do the best for you. If that's a Canadian dividend paying stock and you're comfortable with that, and you have a slight clawback in OAS, you'd have to look at the cost benefit of that. But I don't know if I'd change your whole investment strategy just to save a couple bucks for old age security clawback. So again, if it's massive, yeah, maybe, but I don't know if you want to change your whole investment strategy just for the old age security clawback. So again, not many people would run into this, but if you are, I'd consider that. Like, is it really worth changing that whole investment mindset for a few dollars for OAS? I don't know if it is. Service Canada has my projected CPP payment very low, and I've been at home raising my children for many years. How much can I expect the child rearing provision to provide? It would be nice to know for planning purposes. Yeah, it sure would be nice. And you can actually find that out. So if you go to the PWL CPP calculator, they've built a great calculator and you can put the years of your kid's birth, what you're making before then, after then, if anything, and it'll take those dropout years and give you a more accurate CPP number. So again, the PWL CPP calculator is a great resource in times like this. Question number 6, would it be a good idea to stop the growth of the RRSP RRIF by going 100% cash, withdrawing 2 times the minimum, and then invest what you withdrawn into index ETFs? So when you pass away, you'll have a much lower amount in the RRIF than if you continue to let it grow. So the second part of that question is all about our RRSP meltdown. Like, how do we draw down or draw out your RRSP or your RRIF through retirement in the most tax efficient way and make sure it's gone by life expectancy or a little bit before that? Now, converting 100% cash, drawing at 2x, I wouldn't do that. Again, the cash wedge, have 3 or 5 years of income set aside. So whatever your income need is out of your RRIF account, sure, you could have that in cash, but the rest could be working for you. For most people, if you move 100% of your RRSP to cash, earning 2% or less, you may not hit your retirement needs. So again, if you have millions of dollars, sure, this could maybe work. But for most people, this isn't a great strategy. Think about the cash wedge. Build a great plan, know how much you should be taking out, put 3 to 5 years in cash or a cash-like product that's not tied to markets, and let the rest work for you so you can still average a decent rate of return. Question number 7, is there such a thing as spousal RRIF? If withdrawal from spousal RRSP, how much banking fees, withholding tax, etc.? So I won't go into that second part, that's another question, but is there such thing as a spousal RRIF? Yes, there is. So your spousal RRSP rolls over to the spousal RRIF. Now remember, there's an attribution rule, meaning that the year you put in your last contribution to a spousal RRSP and the next 2 years, if you draw money out of the spousal RRSP or the spousal RRIF, that money will be attributed back to the person that put the money in. So again, if I put money in for my wife into her spousal RRSP 2 years ago, if I put $5,000 in and now I pull $5,000, now the income will actually be triggered back to me. Now, one thing with a spousal RRIF, the minimum amount, so the RRIF minimum is not attributed back to me. So again, if I did $5,000, but we were old enough to convert the RRSP, the spousal RRSP to a spousal RRIF, we pulled out the minimum, which is say $1,000, that would be taxed in my wife's hands, not mine. So again, anything this year or the previous 2 years of contributions will be taxed back to the contributor, other than the minimum RRIF. Beyond 3 years, everything will be taxed to the person that owns that account. So in this case, it would be my wife. Question number 8, is it possible that people in lower tax brackets, say 33%, combined provincial, still have $1.5 million RRSP? In that case, are they still buying RRSPs? And we've done a few videos on this where RRSPs almost always make sense. Typically, especially later in your career, you're making the most money you've ever made, RRSPs are gonna make sense. And again, look at what is your marginal rate right now, and if it's say 33%, look at your average rate in retirement. It's probably single digits or low double digits. So there's probably a decent spread. If you put money in today and get 33% back, and you're paying on average 13 in retirement, that's a 20% spread. So yes, there's a rare occasion where an RRSP doesn't make sense kind of once you get a big $1.5 million RRSP already. But for the majority of you, keep pumping away. It probably still makes the most sense. And if you're really worried about it, sit down with your financial planner and look at, saving an RRSP versus doing something else, TFSA, non-reg, etc. So look at what the best option is for you as you gear up for retirement. Question number 9 is a bit of a longer one. I'll let you kind of pause here and read it. But the highlight here is my friend's husband started collecting CPP at 60. She started collecting hers at 62. She's now 64. Her husband's nearly 70 and is high risk. She said that she chose to take her CPP early because if her husband dies early, her CPP will be topped up closer to what her max would be otherwise. And this is a conversation we've had lots with many clients. Again, if your spouse passes away, the CPP benefit, death benefit isn't that great. You get $2,500 up front, and then depends if you're younger than 65 or older than 65, the death benefit's a little bit different. Won't cover that right now. We have full videos on that, or you can Google it and find out all about that. But don't make your CPP decision just based on this, right? Again, how we run these things with our clients. Run through the what if scenario. What if we delayed CPP till 70, and then at 71, my spouse passed away? Like, what is the true cost of that? Run these scenarios, because again and again, what this person made, that decision of taking it 60 and 62, probably not a great financial decision. Psychologically, maybe good for them, but if they could have wrapped their head around the financial aspect to it, they probably would have been in a much better position had they waited. Again, everyone's situation is different, but run the what if with your financial planner to see, well, yeah, what if we did delay it and then someone died early? Like, is that going to cost us? Are we going to be okay? Would we have been better off taking it early? These are things you should be running with your financial planner. Question number 10. Perhaps this is a question for the podcast, but have you done a similar video analysis on an imaginary couple with no RRSPs, but with $1 million non-registered account versus $1 million RRSP? It's basically a matter of making sure that their individual non-registered accounts each generate roughly 50% of their income. So yeah, if you're building up a large non-registered account, ideally you have it joint. Obviously there's estate planning issues, and tax issues, and marriage issues, and all that go along with it. But ideally you want, if you have a lot of taxable assets or income, you want to make sure that that's split more 50-50. If one person has a $3 million non-reg, the other person has 0, you're not in a great tax position when it comes to retirement. As well, if you're no RSP, really heavy non-reg, ideally large TFSA, Be aware of your investments and tax structure within those two accounts, right? Your TFSA grows tax-free. Your non-reg, you pay tax on the growth. So capital gains would be the best option, dividends second best, interest income third. So again, you need to massage your portfolios a little bit different based on what types of accounts you have. But definitely you want, whether you're building up RSPs or in this case a non-reg, you want to make sure that you're entering retirement to be able to split income, whatever your assets look like. So make sure, again, sit down with your financial planner to make sure that you're actually building your asset base in a proper way. Question number 11, if my wife has worked a few years before we had kids, does she need to go back to work in order to get CPP? CRA states, must have made an eligible contribution, but what is eligible? So the quick answer is no, your wife does not have to go back to work in this case. She's paid some money into CPP, she's been in Canada, she will get some PPP. She'll also get credit for time that you guys had kids. Again, like I mentioned earlier, go to the PWL calculator, we'll link that below, and put in your wife's information. Put in how much she put into CPP way back in the day, put in your kids' birth years and all of that, and it will give out what she should expect at age 65 or a little bit before or after based on that data. So again, PWL calculator for your CPP is a great resource to look at in situations like this. The 12th and final question here. If you set up a RRIF before age 71, do you recommend your clients holding only safe assets, cash bonds, etc., and keeping equities in the RRSP? Then during good markets, sell equities in the RRSP and top up the existing RRIF. So for most of you, you're converting all of your RRSP over to a RRIF. But yeah, there's a handful of you where you're moving a little bit from your RRSP to a RRIF and then taking out of the RRIF. And that's kind of like your cash wedge, right? Like figure out what is 3 to 5 years of income. If you're putting 3 years of income into your RRIF, then yeah, that should be cash or cash-like product so that it's not tied to the market. So in a case like this, yeah, you would want to keep your RRIF quite safe. And your RRSPs could be more longer term. And yes, in good markets, that could now drive up and replenish that RRIF account. But again, whether you look at it from a RRIF, RRSP, I would take that out altogether. Figure out what your income need is out of your RRSP and RRIF as a bubble, right? RRSP, RRIF is the same account. It's just converted in retirement. What is your income need? 3 years? Put that aside. So if you're going to kind of complicate it, move RRSP to RRIF and have both accounts and all that, yeah, your RRIF needs to have 3 years of cash flow in cash or cash-like product. So that's the best solution. So in this case, yes, this doesn't sound like a bad idea. If you're going to complicate it with that RRSP RRIF, both of it, and there may be a reason for that. So there's 12 questions answered in 12 minutes. Hope you enjoyed it. If you enjoy content like this, and if you like this new series, maybe we'll start it on a monthly basis. Again, leave a comment below, like it, hit subscribe. A lot of you watching our videos are still not subscribed. Hit the subscribe button. We do 3 videos every week around retirement, tax, and estate planning for Canadians. We'll see you in the next one.